markets as a senior managing director. Sebastian earned a Bachelor's of Science and Business Administration of Sherbrooke University and the Chartered Financial Analyst designation. Sebastian co-authored research papers for the Journal of Portfolio Management in 2003, 2010, 2011, and the Financial Analyst Journal 2010 and 2014, and is the author of Beyond Diversification, What Every Investor Needs to Know About Asset Allocation. He is the co-author of Factor Investing and the CFA Institute. Sebastian is a member of the board of Financial Analyst Journal and the research committee and the Institute for Quantitative Research, Q Group. And he's also appears on financial media and Bloomberg and CNBC. So anyway, take it away, Sebastian.
Thank you, Hugh. I'm going to share my screen here, so if we can give me a second. So in our division at Pure Price, we manage target date strategies, multi-asset balance strategies, a whole suite of model portfolios for advisors, risk management overlays and risk hedging strategies, as well as multi-asset, multi-strategy liquid funds. By the way, Street, there's a fair amount of static noise on the recording here. I don't know if you can mute some of the participants. Perfect. So I spent the first 10 years of my career in Boston, where I worked at State Street, and I have really good memories of the Coiffa Few meetings. You know, in a weird bar type venue with these animal heads on the wall, and I remember Hugh bringing the cheese and the crackers and the wine and the people playing this very unusual kind of tennis in the background where you bounce the ball off the walls. So I have very fond memories of Coiffa Few. I'm really excited to present here virtually for Coiffa Few. But my most important memory of this group is the level of sophistication of the audience and the debates. So thank you for inviting me to present and discuss my book. I've really been looking forward to it. In fact, I'm presenting here from our vacation rental house during spring break with the family. They're all upstairs watching a movie, and I've asked them to keep the dog quiet. So we'll see how that goes. Hopefully my connection will hold up as well. If it doesn't, bear with me and we'll reset it and we'll make it work. This presentation is based on my book. The title is Beyond Diversification, was just published a few months ago by McGraw-Hill. And if you ask me what's the best investment advice you can give someone, let's say you have 30 seconds to give someone investment advice in an elevator between floors 2 and 4, what do you say? I would probably say A, diversify, and B, stay invested for the long run. But the issue, and this is good advice if you got 30 seconds, but the issue is that diversification is a flawed concept. My view is that professional investors, as professional investors, we must be going beyond simple diversification for our clients. So today we'll talk about return forecasting, risk forecasting, and portfolio optimization. So in terms of quantitative content, I think this presentation will be lighter, I think, than most Coiffa Few presentations on the quant side. One of the reasons I decided to write the book was to reconcile what we as an industry, I think, are still struggling to reconcile: quantitative methods with fundamental or qualitative insights. So when in doubt, you'll see that in this presentation, I favor simple math, transparent, intuitive methodologies, because I also kind of want to reach the fundamental investors. Another goal for the book, by the way, was to reconcile bottom-up and top-down investment approaches. I won't be talking about that today, but for those interested, know that there's a chapter in the book where I talk about our allocation committee And I explain how we bring security level, like think stock picking insights into top-down asset allocation decisions in practice. But for today, it's more about how do we reconcile quantitative and fundamental. And the theme of the presentation is all about portfolio construction. So why go beyond diversification? Like, my key message is that, okay, portfolio optimization is useful. It's a useful framework for portfolio construction. So this is basically a presentation about why QuafaView is awesome. Despite the research that claims the contrary, to me, portfolio optimization certainly beats the pence off of equal weighting all your investments. And in any case, if you're a 1/n investor, which means you put equal weights across all your investment choices, you also need to figure out what's on the menu, right? What do you diversify across? And that really matters. Here's one way to think about this. It's an example from academic research and using data from 2 real-life defined contribution plans, one offered by an airline company and the other by a university. This is a 2001 paper by Bernazzi and Thaler, and we all know Thaler won the Nobel Prize. So in the airlines plan, people were given a list of 5 core stock funds and 1 core bond fund. On average, people that were saving in that plan ended up with an allocation of 75% stocks, which, by the way, is aggressive, right? The national average at the time was 57%. In the university's DC defined contribution plan, people were presented with 4 bond funds on the menu and only 1 stock fund. Guess what happened? Because there's a tendency to spread your money equally across whatever is presented to you. People ended up with very conservative portfolios, average allocations of 34% in stocks. So this is just an anecdote to say that the asset allocation decision sometimes for a lot of investors is driven a lot by what you actually present to them on the menu, not by actual tolerance for risk. So my view is that using a replicable process to calibrate portfolios to investors' risk tolerance is one of the key and much underappreciated benefits of portfolio optimizations. If you're an advisor, for example, and you need to advise multiple clients, I believe portfolio optimization improves risk-adjusted returns over time. And the reason is that despite the fact that forecasting financial markets is extremely hard, asset class returns and risks are forecastable enough for portfolio optimization to add value. So I'll try to make that case. This is the theme of the presentation, right? If portfolio optimization is useful, we need to make the case that returns and risks for asset classes are kind of reasonably forecastable. And of course, I'll need to address the issue of fat tails, which is quite important for portfolio construction. Let's look at the next slide. You don't need to read this, but let me explain. To measure forecastability, if I want to make statements that returns are forecastable to a certain extent, I'll look at the correlation between simple return signals and subsequent returns. Just a correlation. So these types of tests are basically as simple as it gets. And when I chose this approach, I was inspired by Ilmanen's really good book on expected returns. He uses that. But those correlations aren't perfect, right? The disclaimer on this page explains that you basically should expect more extreme results the longer the time horizon, because I use overlapping data. There's an advantage to using overlapping data. It gives me more data points. But these extreme results, either positive or negative predictability of returns, don't necessarily indicate as much forecasting power as it may look, because they're a consequence of a statistical bias that is actually really well explained in a recent paper by Buduk, Israel, and Richardson. So for QuafaView, I felt I had to start with this disclaimer. We're going to look at correlations between return signals and realized returns. When we extend the time horizon, we're going to find more extreme results. This is in part indicating more forecastability at longer horizons, but also reflecting that bias that's built in overlapping data. Let's start with long run return forecasts for stocks and bonds. So these are forecasts really useful for strategic asset allocation. So on the left of the slide is a really well-known chart, uses data going all the way back to 1881. We can debate whether it makes sense to go back to the horse and buggy era. I don't think it does, but bear with me for now. The chart shows the relationship between the Shiller-Cape ratio, so the ratio of the S&P's price to trailing 10-year earnings adjusted for inflation, and subsequent 10-year equity returns. The correlation is 54%. It's not bad, right? So when markets are expensive, subsequent returns tend to be lower over the next 10 years, and vice versa when markets are cheap. On the right, I have my own home-cooked version of this chart, but using the quote-unquote Jeremy Siegel's approach, which uses more recent earnings instead of the trailing 10-year earnings in the Cape ratio. So because of data availability from 1881 to 1990, I used trailing 12-month earnings for the price-earning ratio. And after 1990, when I get the data, I use forward 12-month earnings, which is convenient because after 1990, there are a few periods where trailing 12-month earnings went berserk and the price earnings went berserk, so it doesn't really work well. So trailing 12 months up to 1990, forward 12 months after 1990. The fit is different, right? But it's also quite good. And the correlation is about the same, interestingly, which shows there's, the Cape ratio is somewhat controversial as a predictor of long-run returns. It's been elevated for about 20 years. Due to earnings changes in terms of conventions, accounting conventions, technology weight in the index, how margins have changed for technology companies. But nonetheless, these two charts simply tell us that if you have a long horizon, you should pay attention to valuation levels, buy low, sell high type of advice, nothing really complicated. Let's look at bonds now. The fit for bonds between the yield and subsequent 10-year returns is remarkable. When I worked at PIMCO, I used to say in almost all my presentations, bonds are awesome. Now I work at T. Rowe, so stocks are awesome too. But this chart's a very well-known chart. The starting yield, the x-axis, is a very strong predictor of subsequent bond returns. Correlation is remarkable, 91%. Besides return predictability, there are two additional related investment takeaways here if you're long-term investors. If you're a long-term investor, first, rising rates are good for bonds. Rising rates are good for bonds if you have a long-run horizon, because when rates rise, your expected return on bonds goes up. And related to that, over time, the initial price shocks that you get on bonds due to rate hikes get offset by the fact that your reinvestment rate goes up with rate hikes. So if you're a constant duration investor, so say you buy a bond index, you get remarkable predictability just from the yield as your expected return, because these two effects, the reinvestment effect and the price shock effect, balance each other almost perfectly, especially when your time horizon is about the same as the duration of the bond portfolio. So I'll stop here and just say that bond math is really fascinating to me. If you're an equity quant and you take an interest in bonds and bond math, you're in for a treat. You get all this wonderful determinism with bonds that you don't really have with stocks, and all this predictability. Let's look at the next slide. What do these models tell us about expected returns from here? So say for those of you who advise clients on strategic asset allocation decisions, what should you tell them about expected returns? So the simplest way to convert a valuation ratio into an expected return is simply to invert the price earnings ratio. Just look at the earnings yield. This is, referring back to the slide, it's a reasonably good predictor of returns for stocks over the long run. So on the left here, I show that if you take the data as it is right now, and you calculate the earnings yield on the Cape ratio, so the Cape's at about 35, it's really high. that implies a yield of 2.9%. And then the Siegel model, which again looks at the forward 12-month earnings yield instead of the trailing 10 years, you get a 5% yield. You can then add inflation. So in my book, I explain that I believe the Siegel model is more realistic because of accounting changes over time and changes with technology. But I also think we should pay attention to CAPE levels. So a compromise would be, for example, to calculate an average between the two. And you could put 80% here. I put 80% weight on the Siegel ratio or yield and 20% on the Shiller. Okay, it's not a really sophisticated forecast, but you basically get a 6.8% expected nominal return on stocks. For bonds, I just showed the yield is a really good predictor of long-run return. So that's 1.4% nominal expected return. So the table on the bottom right here shows that these numbers, right, 6.8 and 1.4, are really low relative to what we've received from capital markets over the last 20 years. In fact, if you want an expected return of 6% over the next 5 to 10 years, you need to put 80%, according to these numbers, you need to put 85% of the portfolio in stocks. Over the last 20 years, you could have achieved that 6% return with only 6.5% of the portfolio in stocks. Last week, I recorded a podcast for Frank Fabozzi, and I said that low rates have led, people talk about the search for yield. It's beyond that. It's the search for returns. And that has profound implications for capital markets from here on. In the early days of my career, I see Marcus just join the meeting, and Mark, one of the founding fathers of Quantitative. I like to tell this story because I used to go see Marcus was my mentor for many years, and I would complain to Mark a lot about my career. I was never happy with how fast my career was moving. I wasn't getting promotions fast enough and the like. So one day, Mark got impatient, looked at me and said, "Sebastian, do you know the secret to happiness in life?" So I got to the edge of my seat, and Mark looked at me very seriously and said, "Lower your expectations." So if you're involved in strategic asset allocation and you work with clients, that's probably the most important thing you can tell them regarding forward returns. Lower your expectations. What about shorter term return forecastability? Let's look at tactical asset allocation on the next slide. Are returns predictable over shorter horizons? Or again, I just want to make the case here that ultimately portfolio optimization is really useful. It's a really useful tool. And in order to make that case, I need to show that there's some level, there's enough predictability in returns so that it makes it useful, and enough, and actually quite a bit of predictability in risk, and I'll get to that in a minute. But here's my data set to study shorter term return forecasts. This is the data I use in the book. It includes stocks, bonds, and also on the right, tactical relative valuation bets. So I look at predictability in the book at a lot of different time horizons, 1 month, 6 months, 1 year, and so on. And I use as the forecast the valuation signal. So price earning, price to book, or price to cash flow. It's just a tremendous amount of results to boil down. So here for equities, I'm going to show correlations between the cash flow yield, which happens to work a little bit better than the earnings yield or the book yield, and subsequent 12-month, so 1 year ahead, equity returns, both in absolute terms, if you market timing those equity asset classes, and for relative, so tactical signals. For example, will growth outperform value? For bonds, I just showed that the yield's a good long-term predictor. I'll simply use yield as a return predictor here for 12 months ahead returns, and my data sample started in 1995. These are the results. We typically think of valuation signals as long-term signals, and that's in part because of the statistical bias I mentioned earlier, right? The longer the data, the more overlapping the data, and it introduces more extreme correlations between signals and forward return. Valuation does work for shorter term signals. This is what this shows here: buy low, sell high with a 1-year horizon, right? It's that simple. So the chart shows the average correlation between price to cash flow and forward 12-month returns across these equity markets and these equity bets was 36%. Maybe enough to make money over time if you're disciplined and leaning against the wind and taking advantage of those valuation opportunities. And as expected, the yield signal for bonds is even more powerful with 50% correlation. I think that's enough to make money with TAA, but really probably not enough to use as is, as a one signal type of thing. In our process, for example, we found that it adds value over time, but mean reversion doesn't always work, right? So anybody who's been overweight growth stocks versus value for the last 10 years, or international stocks versus the US, you know that you can wait a long, long time for relative valuations to mean revert. And that's why those correlations aren't 100%. So in our process, for example, we'll look at fundamentals, expected earnings growth, macro policy, which matter a lot these days with stimulus measures, and sentiment. So one way to capture sentiment, besides measures like positioning and flows, is to simply look at momentum. But so the second part of this chart on the right shows that trailing 12-month returns have no predictability on forward 12-month returns across these asset classes. That's how I define momentum here. And by the way, I put these bands at these beige bands at plus or minus 20% for, I think, is the zone where you really don't get anything meaningful here. But there are two caveats here. So most quants know that momentum works better when used in combination with valuation. So when an asset class is cheap and momentum is positive, you get a stronger signal to buy than when both signals disagree, right? And there's a famous paper by Asness and others titled Value and Momentum Everywhere. And it really shows how to combine valuation, which are those signals on the left here, and momentum, those signals that don't work here at a 12-month horizon, actually works. And part of the reason why it works in the Value Momentum Everywhere paper and not here is a time horizon. I'm not showing this here, but momentum actually works better at a 1-month horizon than a 12-month horizon. So it's a shorter term signal. And I'll get back to that topic in a few slides. Here are the confidence intervals around these estimates. And the text here is on the chart is meant to give hope to those who believe in momentum, right? So to clarify, these confidence intervals show how the signals work across the different bets, not how one bet works again across time, which you could also produce a confidence interval for. Price to cash flow and yields are good enough signals for 1-year return, but they need to be combined with other factors, is my takeaway. But again, I just want to highlight that, asset class returns are predictable enough, even at tactical horizons. What about risk? So is risk forecastable? The short answer is yes, and risk is forecastable even more than returns. For the book, my colleague Rob Panarello calculated about 36,000 different correlations between trailing and forward volatilities. Skewness, we looked at the persistence in the higher moments, kurtosis, and exposure to loss, various time horizons, various data frequencies, and we tried to tease out this persistence in risk and where it works and how it works best. I'm going to illustrate this with a data sample for equities that goes back to 1927. So that's the data that's listed here. It's the Fama French data. Really neat data available for free on the internet if you want to play around with it. Here are the results. Okay, let me illustrate how to read this massive table here. If you go to the top left corner of the entire table, you see 79% there. That's the correlation between trailing 21-day volatility and forward 21-day volatility. 69% is really high. If you ran the same thing with returns, trailing 21-day returns with forward 21-day returns, you'd get 0%. And that's a result that's been documented in different papers. The then across the table, I vary the length of the lag and the frequency of the predictor data, as well as the frequency and the horizon of the predicted data. Note that the first column here across, if you look down, uses daily data to build the risk forecast. The second column, the middle of the slide, uses weekly data to build a risk forecast. And the third uses monthly. This is all very mundane kind of work, just empirical, simple work. But what I found frustrating looking at risk forecasting models was that in a lot of the best academic studies, the authors barely disclose actually what they're doing in terms of the frequency of the data and why they choose a certain length of window to build their models on. So we just wanted to dig into that. And we found that, the numbers in the first column tend to be higher, which means that, the more data, daily data tends to work a little bit better, even if you're forecasting a year ahead volatility. So you tend to get marginally better forecasts when you use daily data. Another observation is that volatility, generally speaking, and you can see this in the numbers, is most forecastable at the kind of 1 to 12 month horizon. Harder to model persistence and volatility at the 3 or 5 year horizon. Anyways, you can get lost in the stable interpreting the results. The bottom line, there's a lot of green. Volatility is persistent across various time horizons. And it's actually quite forecastable using this random walk approach, which simply extrapolates recent volatility into the future. The problem is that volatility doesn't necessarily translate into exposure to loss, right? Because of the higher moments and the fat tail issues. And I don't have it here, but in the book, I replicate that chart for skewness and kurtosis and look at different time horizons, and I get much less predictability. But nonetheless, we need to take those into account. And ultimately, if we don't, we risk loading up on asset classes that have negative skewness, because asset classes that have low volatility but negative skewness. Okay, I'm going to pause here because someone needs to go on mute.
I guess, Sebastian, can you ask Nick and Miguel to be on mute, or you can mute everybody?
Okay, I just muted Nick, and it looks like it did the trick. Is that good, Sri?
Yeah, that's fine. Thanks.
Okay, so yeah, negative skewness matters quite a bit. And if you're not careful, you're going to load up on these asset classes. These risk premia, for example, have a lot of negative skewness. Even credit itself is inherently negatively skewed. So we had this idea about a paper on mean variance optimization to show that it tends to load on strategies that have low vol but large negative tails. So strategies that have small blow up risk. And I can't remember who it was that suggested this idea, but it was turned down by our marketing and compliance department. But the idea for the title of the paper to show how optimizers can, if you don't account for exposure to loss, can load up on negatively skewed assets was Skew U, says the mean variance optimizer. This never made it through, never made it through a compliance department, but you get the idea is that if you're not careful, you only focus on volatility, you might just load up on picking up pennies in front of a steamroller. I'll get back to that in a second. But ultimately, exposure to loss, and this is what is shown here in the chart, this is the same approach where we see if tail risk as measured by conditional value at risk is persistent. And it shows there's enough persistence to make it forecastable. And I'm sure all of you can do better in terms of modeling risk on a forward-looking basis than just using the past or the persistence model or the random walk model. But it says, it just shows there is, again, some predictability. On fat tails, I think it's really important to address it. This is such a well-known issue, and especially for everybody in Kwafafiu. Andrew Lowe says this is a quote here by Andrew Lowe, but I would argue that aside for quantitative analysts, I would argue that in a lot of areas in our industry, people still underestimate the importance of fat tails, especially when people quote Sharpe ratios, which use the volatility as the denominator. When people show you really high Sharpe ratios, is, you know, sometimes it's just embedded tail rate. I just find that we don't pay attention enough to it, especially when we backtest factor premias, for example. Someone once told me that the only people capable of generating a Sharpe ratio of 3 were either Bernie Madoff or quants running backtests, right? So this extreme example, but here's an example that I mentioned in the book. 2001 paper by Andrew Lowe. He presented a really good case study on this issue. It's based on monthly data. He ran a backtest from January 92 to December 99. He simulated an investment strategy that required no investment skill whatsoever. Okay, no analysis, no foresight, no judgment. A strategy so simple a monkey could do it. But despite the simplicity, okay, in his backtest, this was a paper about hedge fund risk. The strategy doubled the Sharpe ratio of the S&P 500. And I have it here, it's from 0.98 to 1.94. And it only experienced 6 negative months compared to 36 for the S&P. So if you read the paper, Andrew Lowe says, by all account, this is an enormously successful hedge fund with a track record that would be the envy of most managers. And then he reveals what the strategy is. I'm going to ask Shri. Shri, can you guess what that strategy is? No skill whatsoever. Double the Sharpe ratio on the S&P 500 during the 90s. Not to put you on the spot, Shri, but.
I'm sorry, there was a little bit of, could you repeat the question, Sebastian? Sorry.
The question is, there's a strategy that requires no skill whatsoever, and it doubles the Sharpe ratio on the S&P 500 in a backtest from the 90s. Doubles. What is the strategy? And this speaks to the flaws of just using volatility as your risk measure, which is part of the Sharpe ratio. Any guess, Sri?
Beats me.
So he basically, the strategy was to sell out of the money put options. Okay, so essentially you just load up on tail risk, pick up pennies in front of a steamroller, and because you didn't have a large tail event in that data sample, you didn't capture it in the Sharpe ratio. So, if you look under the hood of many of those risk premium strategies, and there's nothing wrong with these strategies, they have their place in portfolios, but you got to model them correctly, right? So those focus on carry, on credit, on volatility, on liquidity. They're often implicitly short an option.
Wow.
Tail events also importantly have major implications for how we think about diversification. This is a chart from an FAJ paper my colleague Rob Panarello and I published in 2018. I also talk about this in the book. It shows something we all really know well on the left, that correlations across asset classes spike when markets sell off. So you see this in the bars on the left of the chart. Those are sort of the correlations between asset classes in the bottom 1% of US stock returns. And you might think 1% is a small data sample. I'll get back to that in a second. We have an augmentation methodology we applied here. But what's perhaps underappreciated, and I go back to Mark Kritzman, again, mentored me for so long, telling me this, and I remember it like it was yesterday in his office, right, is diversification, not only does it just not work well in those sell-offs, but when it works the best, the absolute best, when you don't want it, when you want it the least on the upside. And those are the bars on the right. Those are the 1% best rallies in the S&P 500. And you see how the correlations now go down and diversification seems to work. So it's like having your head in the freezer, your feet in, and you claim that your average body temperature is fine, right? And your chances of survival are fine. So the point is to use average correlations to assess diversification as a way to mitigate exposure to loss is highly misleading, because these correlations are an average of two extremes. The simple average historical correlations are an average of two extremes. By the way, for the data augmentation here, it's in the appendix of the paper, but we didn't simply carve out the left and right 1%. We used an exponential weight and calibrated the midpoint, the half-life at the percentile. So you start borrowing data from the rest of the distribution to augment it, but at an exponentially lower weight the further you are from the tail under consideration. That's the methodology is in the paper here. But there are many ways of dealing with this issue with a variety of analytical techniques, many of which all of you are familiar, as QAFA few members. But ultimately, is portfolio optimization useful, right? So there's a debate here. The quote on the left is from a paper by de Miguel, Galarpi, and Upal. And this is what they say. Of the 14 models we evaluate across 7 empirical data sets, big data sample, none is consistently better than the equal weight 1/n rule in terms of Sharpe ratios, certainty equivalent, return or turnover, which indicates that out of sample, the gain from optimal diversification, from portfolio optimization, is more than offset by estimation error. Okay, on the right is a quote from a paper I co-authored with Mark Kritzman and David Turkington. Using naive but plausible expected returns, volatilities and correlations, which really relates to what I've just shown, right? These aren't really sophisticated forecasts here. And they just work, they work well enough. Short-term, long-term equity, bonds. We demonstrated that in a variety of applications that optimal portfolios generate superior out-of-sample performance compared to equal-weighted portfolio. So who's right? In our paper, we explain that the main issue with the de Miguel, Garlapi, and Upal study was that the authors used various versions of the trailing 5-year returns as expected returns. And while this works for risk forecasting, and if you backtest just the risk minimizing portfolio, you'll see it works, it doesn't work for returns. And it's even worse than you think. So here's a chart from my book. It shows the correlation between trailing and forward returns for a broad range of equity asset classes for various lead-lag relationships. The texture of the lines tell you how far back we go for the look back. And then recall, for example, that earlier when I used the trailing 12-month returns as forecast for the forward 12-month returns, when I defined momentum that way, I got essentially zero predictability. If you start on the x-axis here, look at the 1-year horizon label, move up to the second line, which is for the 1-year look back. So 1-year horizon, 1-year look back, we see that we're close to zero correlation. But go to the right of the chart, at the 3-year horizon, right? Interestingly, as you can see on the right, we get negative correlations. So mean reversion. High returns are followed by low returns and vice versa. And if you were to extend this to 5 years, the numbers will get even more negative. So this means that this is a mean reversion effect. It's been documented before. There's a famous 1985 paper by DeBont and Thaler, for example, on this. But the de Miguel, Garlapi, and Upal study use these trailing 5 years returns as the basis for their forecasts for their mean variance optimization. And the correlation is negative. They should actually have done the opposite. So of course, mean variance does badly relative to 1/n. It's not just that it's not predictable, it's actually that there's mean reversion and they assume momentum. In fact, they basically should have inverted the signal. I bet you go back, haven't done it. I bet you go back and redo that study, but invert the signal for the returns. I bet you it beats 1/n because of this persistent mean reversion, which has been documented before. So the difference in our paper, we just showed that results are compatible with basically what I've shown in the presentation. Return and risks are forecastable enough, not perfectly, but enough. And therefore, we showed that optimization had value. As long as expected returns are reasonable, say proportional to risk or long-term risk premia, it's really not rocket science. As for the portfolio optimization algos themselves, you could have many quite a few discussions on this. There are many of them. They often they're different in how they account for fat tails, for example. Look, I got that question from Frank Fabosi in the podcast last week too. I think they're all useful. You know, Black Litterman helps you impose consistency in your forecasts, helps you avoid corner solutions. It helps blend qualitative forecasts with quantitative inputs. I even think like risk parity is useful because it forces you to think in terms of risk budgets rather than capital allocation. And there are all these models on the slide, a variety of models to help you model the fat tails issues that I mentioned in this presentation. In our process, especially for strategic asset allocation, we regularly test a lot of these models. We compare the results and we strive for robustness, which is it's a wonky term, but it basically means my view is you shouldn't be dogmatic about when you try to forecast the future. So you try to find a solution that maybe doesn't work perfectly for any specific model, but that works really well across models and scenarios. There's this idea of robustness. That's how we do it, and it works for us. What's odd to me is that in quant and academic circles, I found that even in my team, people have strangely strong and dogmatic views about which optimization model is the best and ought to be used everywhere. It's almost more controversial to talk about optimization than talk about politics or religion in certain circles. So I'm not sure why. I think these models are all useful, and you explore the data and you strive for robustness, and you know that it's a scalable process. And I think these, again, that's the key message today, is that optimization is useful for portfolio construction, and I show that in different parts of the book. This is a list of takeaways from the presentation. We'll make the slides available. You can read these takeaways at your leisure. But to conclude, I will end with a true story. Several years ago, I was half asleep at a quant research conference, and it's late today. Hopefully you're not all half asleep. Really looking forward to taking some questions. But at that point, a fundamental portfolio managers asked the presenter about the GIGO critique, garbage in, garbage out. He was arguing that because you can't estimate expected returns with any reasonable level of confidence, garbage in, the output of portfolio optimization models will always be wrong, garbage out, and we should therefore ignore all this quant mumbo jumbo. So this was a fundamental investor challenging a quant presenter. The presenter is Bernd Scherer. I don't know if some of you know him. He's a highly regarded thought leader. I think very highly of him, but he was not in the mood for a discussion on the GIGO critique. So in one short sentence, he gave the most remarkable rebuttal of the critique I have ever heard, and I've used it since then. And this is what he said to the person asking about the GIGO critique, garbage in, garbage out. He looked at him and he said, if you don't think you can estimate expected returns, you shouldn't be in the investment business. So the point was, investing is mostly about forecasting. Even if you don't formulate expected returns as a precise number, you make implicit forecasts when you allocate assets. And yes, that includes risk parity investors. They also make implicit forecasts. The act of investing, to me, is the act of forecasting. And I 2 years of my career at State Street, I was still going to Quafa Few. I was in Boston back then. Significant part of my responsibilities was to help develop quant expected return models. And clients would often say, your approach doesn't work. It's not because it's not forward-looking, right? It's based on past data, and the current environment is different, which is really, it's a really valid concern. I love the job at State Street, but the travel was grueling. So one day, like Dr. Scherer, I was jet lagged. I gave client a curt answer. I said, I'm sorry, I've looked everywhere for future data. I can't find any. Future data are not on Bloomberg. So the salesperson was not impressed. The point, and that's the point I've tried to make in this discussion and in the book, historical data are all we have. They're useful to the extent they help formulate a view about the future. It's in that context that I reviewed these models today to forecast returns and risks, about as simple as it gets, and it works. So just remember, portfolio optimization is useful. Thank you.
We'll open up for Q&A and discussion. And Sebastian, I loved the last thing you said about guidance to authors. How many hours did it take for you to write this book?
How many hours?
Yes, or years.
Right. I did it little by little, and I did it over 2.5 years. I got to say, one thing I would say for those interested in publishing a book, don't underestimate the last part where you get an editor and you go to production. That in itself took about 10 months, tested my patience. And I've learned quite a few things in this process. One is you have to have a habit that forces you to write. Otherwise, you can't wait for motivation. You have to give yourself a writing goal and chip away at it little by little. No one's always motivated all the time. Just build a habit of writing. The other one that's really occurring to me right now, and it's in part why I'm here at Quafafu, is I wrote that on the slide. You got to know your audience. And if you think about it, are you trying to write a book for your peers, for experts, or for a mass audience? And where some of you have read the book, you know that I've tried to make it user-friendly, minimize the jargon. And I had this idea in my head that it would be like Malcolm Gladwell style, where there's research behind it, but you make it interesting, and there's no equations in the book. But I still reviewed about 200 papers, so there's content behind it. But I tried to make it user-friendly. And I gotta say, like, the book, I think everybody here on this call will read it and will enjoy it. But for individual investors, I missed the mark. You can see that in my feedback comments on Amazon. I get 1 star and someone says, I don't understand what he's saying. I wanted someone to tell me how to invest my portfolio, what to do, as opposed to how to do things. So know your audience. I wanted to broaden my audience, but there are trade-offs and sacrifices that you do when you do that. So that's my advice. I would say build that writing habit as opposed to waiting for motivation, and really figure out what you're going after in terms of audience.
Thank you.
Sebastian, this is Larry. You had one point when you early in your talk where you said it implied, it sort of sounded like you were saying that value has outperformed growth. But we know a whole lot of managers out there who are value managers for the last 15, 20 years who are still waiting for value to come back. So maybe I misinterpreted what you said.
No, it's exactly what I said, is that if you had been overweight value for the last 10 years, you would have waited for those mean reversion effects for a long time. And the other example is actually international versus US equities. So that's why this cash flow yield across all these bets, if you go back to 95, right? It has a 36% correlation to forward returns. It's not 70, 80, 90. And you have this 10-year chunk of data where 2 of the key bets really did not mean revert. And my point was, this valuation signal is still useful, but you got to put it in context of fundamental macro data and also sentiment and momentum. Now, if you're asking me how we're positioned for the next 12 months in our portfolio, for the first time in 10 years, about 3 months ago, we overweighted value. And if you know T. Rowe Price, we really like growth stocks. So we had been almost systematically overweight growth stocks. First time in 10 years, we started leaning towards value. This doesn't mean we go completely out of growth. It just means we have a tilt towards value as we speak. Finally.
Did you have to swim against the stream there to get the value in the portfolio?
No, because we have the Allocation Committee, we have different types of investors around the table, including value investors.
Okay.
So it's a good debate. Larry, like most of our meetings, these are 2-hour meetings. it's about 60, 70% of the time, value versus growth debate.
So,
Never.
Sebastian, Ralph here. Not to put down Mark's advice, but do any clients or any people we talk to ever, when you say lower expectations, does it ever fly with them? I mean, we have that same thing, and it just is not the answer that clients want to hear.
I think the hardest discussions are probably with individuals for financial advisors. I think institutions don't want to hear that either, but they're often comprised of investment professionals, and the data is all there for everyone to see. So if you make the case clearly, they know, these institutions, they have these 7-8% actuarial returns for the portfolio. They know, and when you talk to them, you advise them, they know these numbers are ambitious. I think the toughest part, Ralph, is these individual investors. And that's part of the role of the advisor, I think. Advisors that advise many different individual investors, a lot of what they do is almost like a psychologist for investors. And it's not easy. And I'm glad I don't do that as part of my work. Does it fly? I think it depends how it's presented, would be my guess.
Sebastian, with bond yields so low, I mean, is there any case for owning fixed income?
I think so, but diminished. So there's, in the last chapter of the book, I have model portfolios where I put it all together. And in the balanced portfolio, we have about 12% that we've shifted from core bonds to liquid alternatives. That includes absolute return bonds, and also includes multi-strategy type, total return type strategies. So that's 12% shift, which I think is a reasonable tweak. The other tweaks we're making to the portfolios are, we have a dedicated 3 to 5% allocation to long bonds, which still have some diversification juice in them, a bit more than lower bonds from a strategic perspective. If you get a couple big market sell-offs, those long bonds will still rise. They rallied 20% in COVID, by the way, and in theory, you still have some juice. So we have that, and then we have things like, we have a risk premium sleeve is about 5%. It's mostly the volatility risk premium. And we have one thing that we're working on is these risk mitigated equity strategies, which have embedded tail risk protection strategies built in within an equity portfolio. Those are becoming part of what advisors are offering, for example. And we probably put about 10%, we're looking at shifting about 10% of beta equal 1 long only equity to risk mitigated equity, which has a tail risk hedge built in, gives you about 80% beta of about, it gives you about 80% of the return of equities with a beta of about 0.5. So it has some attractive characteristics. And these are all ways to get around the fact that really it's uncomfortable to own that much core bonds.
Yeah.
With rates at 1.4%.
Yeah, it sounds like a lot of engineered products here that, I don't know how well they've been tested over time. You have a lot of confidence in them?
Yes, and some of them have been tested over fairly long periods of time. I mean, when I talk about long bonds, it's not really engineered. When I talk about the risk mitigated equities, it's manage volatility and other protection strategies. And when I talk about multi-strategy total return, these are strategies, for example, in our case, that are built off our existing investment platform, but where we express with long short positions. So it's definitely edging towards more complex, more derivatives in the portfolio for sure.
Okay, all right, thanks.
Sebastian, I have a question. My question concerns that chart showing the correlation between trailing returns and forward returns. I'm not sure if you put this together, but I'm curious, given that central banks and their proxies have become increasingly involved in determining equity market outcomes since, say, the great financial crisis, if those correlations have shifted over the past 10 years.
Yes, and you see the impact of central banks on many of these numbers. If you look at the last 10 years versus 30, 40, 50, or in some of those charts, I go back to the horse and buggy era. You see the impact of central banks because they step in as a put to economic downturns and market sell-offs and cause very sharp mean reversion following downturns, like we just had with 25 trillion in stimulus.
Right.
It's the best example. And that's a behavior that's kind of more like the last 10 years of backstop provided by central banks. Now it's not just central banks too. It's 25 trillion in monetary and fiscal. It's both of them together.
Sure.
So really unusual environment. So the short answer is they definitely have an impact on the numbers. If you look at mean reversion effects, they increase the mean reversion effects.
Interesting. I would imagine like the Nikkei returns, with the Bank of Japan and the government pension fund over there, it's probably just a flat line.
Yeah, that's a good counterexample, right? The Japanification effect, where the central bank kept pumping money and buying bonds, and the market never really mean reverted. I think that's an exception to the rule because of demographics and other effects that are more specific to Japan. But believe me, we do have these discussions about Japanification of, I think Europe is probably closer to the US.
Agreed.
And some investors have already left Europe for dead despite central bank intervention and liquidity provision.
Yeah, it seems like we're on the same path.
Yeah. Lower your expectations, Michael.
Sebastian, for the 7 utility functions you listed as the maximizing function or say optimization, any material difference for the eventual cumulative wealth versus, for example, using Sharpe ratio as a function of maximization? And then the second part is which utility functions you would recommend us to use?
So I think it's good to use different utility functions to get a sense for how your forecasts behave when you combine them with the risks and the correlations. So I would not have one specific utility function to use. The question on time horizon is really important. And in my experience, and this is yet another thing, I don't know if Mark is still on the call, but it's yet another thing. Basically, everything I've learned from Mark. So just go out and say that to begin with. The longer term, if you change the time horizon and you want to maximize utility, I think the full scale approach where you actually look at all the return outcomes and you define your utility function, you score all your return outcomes and you directly maximize your utility. It's very much assumption free, if you will. That process is flexible enough for you to incorporate a longer time horizon, cumulative return paths into utility maximization. And you can even combine shorter term horizon volatility constraints or aversion with longer term return, or you could be log wealth longer term and have an aversion to shorter term volatility. These time horizon effects are best handled through direct full scale utility maximization. And the utility function can have a time dependent parameter. We do a lot of life cycle investing modeling, which is really long term, right? Bill Sharpe said life cycle investing is the toughest problem to solve in all of finance. How do you save if you're 30 years from retirement and you want to, when you get to retirement, replace your salary? Well, we do a utility maximization approach to that. And we look at cumulative returns as well as the different ways of dealing with the time component and the aversion to varying your spending over time in retirement. So there's a lot you can do. It's just unlimited in terms of flexibility.
Thank you. Most of the academic research paper published focus on the Sharpe ratio is like the slope, a tangential slope of the wealth. For the eventual investor's wealth, utility function seems a better target for maximizing or optimizing. Do you agree?
Yes, because, well, first of all, this will, depending how you define your utility function, you'll converge to Sharpe ratio maximization. But if you define a utility function where you take into account the exposure to loss directly, and for example, you have a higher aversion to returns below a certain loss threshold, you know, if you say, as an investor, I want to maximize my long-term return, but I really want to try to avoid losses of more than 10% in any given year. The only way to really do that properly is with a flexible utility function that has a kink below minus 10%. And if you just try to do it via the Sharpe ratio maximization, you're going to miss the mark. And again, you're going to load up on credit and those negatively skewed asset classes because they have low vol, but they have high exposure to loss.
Yeah. Thank you. By the way, I love your book. I read it 3 times. You can see from the number of the bookmarks. Yeah, it's an indication. It's the best book of the year 2020. Thank you very much. Superb book.
Really appreciate it. Thank you.
I have to make a pitch for Jared Wilcox's version of the utility function with the skewness and kurtosis in there that you included in your slide. So, Jared.
What a good guy you are, Mary. I think that Sebastian has a good appreciation of higher moments. I don't know how elegant it is, but it certainly sounds like it's on the right track.
Thank you.
Yeah, I want to echo James' thoughts. I read your book too, Seb. Couldn't put it down. And I found in my experience that I've also engaged, or I've had to deal with a lot of dogmatic quant views on the other end of the phone call. And now I have a new tool to throw your way, your book.
Thank you, Chal. I appreciate that. At least I hit the mark with part of my audience. As I said, some of the reviews on Amazon aren't too kind either. So I'll take the good with the bad. I'm learning a lot about internet trolling. So let's see, we're streaming this on YouTube. Let's see how this goes.
Sebastian, I have a question. I'm trying to think of something that won't be too difficult, but will be beyond my knowledge. Does your shop assess risk aversion and model your portfolios with respect to that? It seems like that's one of the parameters that you need. And if you do, how do you do it?
It's a really important question, and people are debating, is the 60-40 portfolio dead? Well, the first thing you have to think about is 60-40 is a specific risk profile that works for a specific risk aversion, but really it depends on a lot of things. Jared, one of the main ways we do this in target date funds, for example, in target date strategies, is to look at how far people are from retirement. Then we can personalize that and open up the utility function by adding, for example, information on people's balances, people's risk tolerance, how much they save over time, employer match. And so you get into what we call a managed account solution, where you have a more personalized glide path that accounts for the risk tolerance. Another thing we do in robo-advisor type strategies is to ask people about 10 different questions. That helps us map them to a certain risk aversion, which then helps us map them to one of 10 different model portfolios. So it's a combination of getting information about people's goals, tolerance, and data that you get from a record keeper, right? How much they make, how far they are from retirement. If they want to engage, we'll ask them more questions and get more data into the risk aversion calculation. The sad thing is that most people don't engage. So you kind of have to figure out what the default should look like based on the information that you have on them. And age and time to retirement is a big one, is the main one.
Good.
Now, there was a, again, this is something Mark mentioned many years ago, that there was research at the MIT where people looked at blood tests and looked at the levels of different hormones people have and mapped those to risk-taking behavior in financial markets. I guess they gave people simulations where they could buy and sell financial assets. And for certain levels of hormones, there was better risk-taking, so there was more risk aversion. So Jared, this would be next level risk tolerance assessment. I think most clients will refuse a blood test, but
I think there's going to be an app on Apple Watch wherein you can monitor things in real time.
Right, we'll give you an EKG and we'll run some tests and tell you how much stocks you should own. I'm joking, by the way, not what we do here.
Sebastian, how do you distinguish between the risk preference that the client thinks they want and what would be good for them?
Unfortunately, those are often not the same. And in the life cycle problem, which again is supposed to be the hardest problem to solve in finance, what people are really looking for is to replace their salary once they retire. Most people are underfunded and they just don't have enough in their retirement account and future contributions to replace their salary to a level that they're trying to achieve. For a lot of people, it actually means maybe the opposite of your question, Jared, actually, that if the time horizon is long enough, they should probably own more stocks than they think they should because they're underfunded, and over time, the expected return on stocks is higher. You get higher volatility along the way, but you end up, in all likelihood, better funded once you reach retirement. So this is one of the difference between what people think their risk tolerance is and what it ought to be, is when they're far from retirement and underfunded. I am probably 15, 20 years from retirement. I'm very comfortable having about 80, 85% of my savings in stocks.
The shameful thing is that 401k is one of the worst things that's ever happened to the United States, I think. And you can see countries around the world where guaranteed income is something that is a function of the society as a whole. When you ask somebody, I can ask you this. I mean, you have hundreds of clients and they have no clue what it is that they're buying or selling. And here the company says, here you go, here's your money. You pick whatever you want to do. I mean, that's almost criminal behavior. I mean, it's just silly. And it just doesn't make any sense to me. But, lo and behold, that's where we are right now. So, I mean, what is the prospect for how many of those people are going to end up, in 65 when they retire and having nothing?
There's a financial advisor put it this way to me once: it's like if you need surgery, you go to a surgeon. You don't do it yourself. And his view was that we've asked people to do something that really they don't have the interest or time or ability to do, which is their own financial planning. Now, the default, Larry, in 401ks used to be cash before the Pension Protection Act of 2006. So if you did nothing and you just put money in the 401k, it would go to a stable value or cash. And so really you had no chance. Like if you get no compounding, okay, and you save 10% of your salary every year, but you get zero compounding, you need to save for 10 years for every year of retirement income, like roughly, right? That's how the math works, 10 to 1. And that's what you get from bonds now. You get zero compounding after inflation. So the default now, and now I'm biased because I'm in the business, but the default now is a balanced allocation, right? Is a target date strategy, and it is calibrated to people's age and time horizon. So I think it empirically does better for people's retirement than cash, for sure.
Well, what do you think of this notion of a pooling to offer annuities? Annuity is really what people want. Well, you said they want their income. They really don't want a target fund. They want to know when I retire, I'm going to be able to have, whatever my income is for a while. So finally, we get this proposal that, for firms can pool their annuities. I know there's some challenges in managing that, but what do you think of that as an alternative? I mean,
it's a huge topic, and talk about a problem that our industry needs to solve is investing in retirement, the retirement income phase. So it's a huge topic for a lot of firms like ourselves trying to figure out the retirement income solution, which is much more difficult than the accumulation part, because when you decumulate, it's very personalized. So for some people, annuities will play a role. And the surprising thing is, if you run surveys, you get a lot of love for annuities. And then when you make them available, people don't take them up. And that's it's a little bit of a behavioral puzzle, if you will. But you can imagine strategies where part of it is in an annuity, which provides an income floor. You'll make at least X every year.
Yeah.
And then the rest is invested for upside participation. There are all sorts of combinations to offer guarantees. The industry has been struggling, trying to innovate in product management around this for about 10 plus years. And no one has really cracked it yet. Now, how do you combine annuities into the picture? How does it work if you want to keep people inside your 401k once they retire? Or do you want them to go to an advisor? So right now, the way the industry is solving it is that people get out of their 401k when they retire, and they get advice. Typically, they go to an advisor, and the advisor does that personalization. And do you want annuities? This is how much income you're going to sell, and the whole financial planning becomes very personalized that way.
Yeah, people don't want the annuities when they're young, but as soon as they get old, they go, "Gee, I wonder why I didn't take that pension offer."
It's almost like people miss the good old DB plan.
One other comment about annuities, I wrote about this a little bit when I wrote about tontines way back when, is they like it conceptually, but the irrevocable decision, I buy annuity, drop the check in the mailbox, assuming we ever use mailboxes, and you get run over by a bus on the way home, it's all gone. And just the idea of the irrevocable decision just was really the barrier to people, buying annuities. And, people give minimum distributions, this and that, but I think they like that guaranteed income, but writing a check to an insurance company and knowing, it's stuck now and for the rest of your life is just a really hurdle for people to overcome.
I think
you also have the problem of low interest rates aren't going to generate a lot of returns.
That too.
And also the guarantees from private companies that may or may not be financially solvent.
Well, that's where you have to bring back my tontine idea.
But I think, Ralph, you hit the nail on the head, though, is the psychological impact of taking your pot of money that you've accumulated, right? All this money, and giving it to an insurance company, and it's gone. And now you've purchased a salary replacement. But I think that while in theory the annuity makes sense, there's a reticence from most investors to just hand it over, and it's completely irrevocable and illiquid. There are ways to make those things more liquid, but it's still not frictionless. So I think you hit the nail on the head on that, Ralph. I think that's a number one factor.
But as soon as people retire, they would really love to have one that had a 5 or 6% return instead of one that now you would get 1 or 2%. Now, yeah, I'm not saying the insurance companies are the people that should be providing them. It's the government that should be providing it. If you took all of the money that people want to put in annuities and put it into a government-sponsored program, like Germany or like any other country in the world that has a plan for this sort of stuff, it would be a layup. You'd have the diversification of all the individuals that would be contributing at different points in their lives. And, I think it would make everybody better off. It certainly would help people sleep at night, knowing that I don't have to worry about my 401k anymore. But
yeah, good point.
Yeah. I mean, I don't want to put you out of business for helping people managing their money. But I'm just saying, as one part of people's wealth and income, it should be, and it should come from the government. It really should.
But even the government is not safe, Larry. I mean, look at the Malaysian retirement plan,
Yes, you're right. Good point.
There's a good book on that too. More entertaining than my book.
Which one is that?
It's the book about the scandal around 1MDB.
Oh.
Oh,
Sebastian,
okay.
let me ask you, we talked about target date funds. I did something internally a while back talking about market drawdowns, recoveries. And historically, at least in the US, even after nasty bear markets, it gets back to trend. It's called 15 years to the longest, maybe most of the time it gets shorter, much shorter. Why, if you're 20 or 30 years out, does it matter? If you're reasonably confident that the market's going to get back to trend within, before you need your money. Why shouldn't everybody be 100% stocks until I'm going to need some money, let's say 20 years from now or 15, pick a date. Until then, you're not, if you believe the market's eventually going to get back to trend, which is a guess, but instead of have a glide path that starts at age 20, why not start the glide path at age 40?
You mean be 90+% invested in stocks all the way to age 40?
If you believe stocks reliably come back to trend within a decade or two, and you're 25 years out from retirement, what about, forgetting the fact that interest rates are zero now, but forgetting that, do you really need that diversification if you can count on, there's no guarantees, but historically the US stock market's always come back to trend within, let's say 15 years, 20 years, maybe after the Great Depression.
Yeah, if you can tolerate the shorter term losses that come along the way.
Sebastian, there's a question that Quants used to hate to answer. Are we in a bubble?
So I think we're definitely seeing localized bubbles, if you will, in things like tech stocks with no revenues, SPACs, IPOs. I think if you look at the market as a whole, we're not, if you look at valuations relative to the level of rates. So take the cash flow yield on the S&P 500, which is one of the highest valued markets right now. Compare that cash flow yield to the yield on the 10-year. Go back to 1953, and you'll find that stocks have been that cheap only 13% of the time since 1953. So if you account for the level of rates and you think dividend discount model, rates went down by so much, well, valuations are elevated, you get some justification. You might ask though, Jared, like, what's the end game there? Does this keep going? At some point, rates hit zero or negative real rates and things get fragile. In the current environment, though, we have expected earnings growth for the S&P 500 of about 25% for 2021. And this is the typical path you get off of a recession. And so the valuation looks high at around, like, say, 22, 23, but there's room for valuation to go down if we do get this 25% earnings growth. It's actually even higher for value stocks and growth stocks and for international stocks. So we're coming off a trough. And my short answer is, like, we're taking relative valuation positions right now that where we think it's advantageous. I mentioned we lean towards value. We've leaned towards small caps for the last 6 months or so. We've leaned towards bank loans, which on a relative basis within fixed income markets are more, in my mind, more attractive than, say, high yield, and they do better in a rising rate environment. So we're taking these pro-recovery positions, but at the top level, we're in our portfolios right now neutral between stocks and bonds. So we recognize valuations are fairly elevated in stocks. And neutral is kind of a boring position, right? I get invited to comment on our positions on Bloomberg TV, and they don't like when I say neutral, but I think now's a good time not to be a hero with, if your 60-40 profile would be at 60-40. We would, under the hood, though, be long the recovery trade.
Okay, well, we'll hope that corporate taxes don't go up.
I think that's a risk, right? I mean, last couple of days, you've seen that in the news flow, definitely. And for individuals too.
Can you hear me?
Yes.
Yep.
Yeah. So Sebastian, there's a lot of work to show that the credit cycle and the business cycle actually are. And I'm wondering if you could just say a little bit about your view on corporate credit and
No, I don't.
high yield at
Your
this point.
pajamas? No.
Let me just try to mute Joe.
So Sebastian, I'll reclaim the host, so I'll take care of it.
Okay.
Yeah, thanks.
Sorry, can you hear me now?
Yeah, so the credit cycle and
The credit cycle and the business cycle, macroeconomists have pointed out, are not coincident, right? There seems to have been a significant, within an era of ultra low rates, significant deterioration in credit underwriting and covenants and cov light. So I'm just wondering if you could talk a little bit about the credit markets in your judgment, where you think relative value is now, and in particular, timing signals for high yield.
right. So default rates have been remarkably low. And so the question is, are we getting through this to the other side without too much damage, which leads to this idea of zombification of a lot of companies that maybe should have been taken out in this recession? Or do we get to a situation where there's sort of pent up defaults? If you look at what credit spreads are pricing in, and the balance sheet models like the Altman Z-score types of models, right? They show that companies have enough cash flows to meet their debt payment because interest rates are so low that we're not heading towards a credit accident, if you will. But I mean, you mentioned the business cycle and the difference with the credit cycle. You know, this business cycle is really highly unusual. We're going back to the level of pre-recession GDP in about 2 years. And the prior recessions is basically usually takes 5 to 6 years. We're going back to pre-COVID earnings much faster than in prior recessions. The data is similar for unemployment too, because a lot of it is still temporary unemployment. So it really is an unusual snapback. So I'm not too worried about credit, except that valuations are really expensive. But this could be a reasonable carry environment, given that the alternatives are, you know, because rates are so low, the search for yield, and equity valuations are so high. So relative valuation, I mentioned bank loans. I think if you put bank loans side to side with high yield, and you get like 4.5%, 5% yield for both, you have one that is actually higher in the capital structure in bank loans. You get less sensitivity to energy, which has really rallied back. So less energy related volatility. And you get reset the bank loan payments every 90 days. So if rates rise, you'll do all else being equal, should do better with the bank loan. So that's one of the best, I think, relative value opportunities right now in fixed income markets.
Sebastian, we mentioned target date funds a couple of times, and there's a structure that, you know, probably has to change a lot with interest rates so low, or is it, as you're saying, you don't think that this is going to be a permanent, you know, hypothesis that we're going to be stuck at low rates for a while, so we don't have to really re-engineer all those target date funds that are out there?
I think that low rates fundamentally, and given how low they are, change the investment outlook going forward, even in the long run. And parts of the presentation show that. And I think that they fundamentally force all of us to rethink portfolio construction. And we have re-optimized our target date funds, our glide paths, we've enhanced them to account for lower rates. I think it's a huge shift in capital markets, and plus the liquidity and this unbelievable impulse in liquidity that we've had. You know, you have 1 trillion in additional, it's unequal, and it's really sad that it's unequal, but you have 1 trillion in additional personal disposable income in aggregate relative to 2019, an extra 1 trillion. And you have, you know, so you still have this liquidity flooding the markets, which will drive the environment going forward. So I've deviated from your question, which was the structural long run impact of low rates. My answer is yes, there is a structural long run impact, and it forces all of us to rethink portfolio construction.
Including the 401ks, yeah. And the target date funds, sure.
Yes. I went sideways a little bit on the question. Apologies for that.
No, you're spot on. Thank you.
Okay, Shri, I think
That's all the questions. I think there was one question in the chat window from, I don't know if Alexander Ryer is still here.
Yeah, sir, I didn't want to interrupt his train of thought. I think the gist of my question is really, is there a place for adaptation and considering the regime, like the state of everything you know at this point, as opposed to looking across time and averaging things? So using something like measures of systemic risk or changes in the VIX or changes in valuation spreads, you know, all of the information that you have, if you can look at things in a regime context, is there any usefulness to that?
Absolutely. I think that regimes are persistent, and they explain part of the forecastability in risk measures. The tricky part is to think about the regime shifts. And when you go from one state to the other, that's where fortunes are made or lost. But a framework that accounts for regimes and that assigns probability that we're in regime 1 or regime 2, risk on or risk off. And over the last year or so, there are 2 more regimes to think about as asset allocators: COVID on and COVID off. And they have very different, you can assign probability to them, but they have very different expected returns for growth stocks versus value stocks, for small versus large, for reopening. So that's another way of thinking about it. I also see that in your question, you had something about principal components and systemic risk, which allow you to look at markets over time and how one factor can drive a lot of the volatility in across asset classes at one point in time. And the higher the percentage of volatility explained by one single or two principal components, 2 factors, if you will, introduces fragility and systemic risk in the financial markets. I think that there's predictability there as well. You know, I didn't touch any of that in the presentation, but because the presentation, when you think about it, was just so simple. It was just persistence, right? And different metrics and simple forecasts. But if you add the regime dimension, you can do a lot more. You can do a lot better than what I'm showing. So yes.
That was a favorite part of your research with Mark at one point or another, right?
Yep.
So
Sebastian, what are the risks of investing in emerging markets this time? And it has not worked well during the last, let's say, 10 years, especially given the tension between US and China. Should the investor avoid investing in China in particular?
Ooh.
Well, I don't think they should avoid it altogether, because it's such a big market and there are lots of opportunities in stocks and bonds for security selection. And there is growth there that we've just seen can be differentiated from the rest of the world. And I'm making completely apolitical comments here. It's just from an investment perspective. The broader question on emerging markets is that really emerging markets have changed a lot. And even if you think about China, the percentage of the index that's growth, that's large tech companies, is much higher than it's been historically. So you're really looking at a different asset class. If you run a back test, even from 10 years ago, look at how the sector composition has changed. So emerging markets are more high tech than they used to. So I think the prospect for valuation aware emerging market investing are good. We split the allocation right now between growthy emerging markets allocations, strategies, and value. And I think that right now emerging markets value, there's a really good long-term case to be made for that as an asset class, given where we are in the cycle. So short answer, James, is I think the asset classes change and the prospects, if you account for valuations and growth and opportunities in value and growth and style diversification, overall is quite good for emerging markets.
Sebastian, I had a question, and this is probably not not a specific one. So I'm starting to teach a fintech class at Northeastern starting this Saturday. And many of the themes are Robinhood. How do you look at Twitter and some of the tweets which are gonna, make a stock go up or down? Look at Reddit and subreddit forums. So how would you advise a 20-something person who's, kind of getting their first set of paychecks? They're trying to figure out, and they have absolutely no clue about portfolio management, diversification, asset allocation. How do we kind of convince these folks to start doing some rigorous methodological investments?
Instead of just buying Bitcoins?
Instead of, I forgot Bitcoin, but the I mean, these are all themes in my class, right? So I have to talk about them. And I was wondering, what would you say to a 20-something person on investments?
So Sri, you're going to teach a class of them?
It's a graduate business class on fintech. So we're looking at the 8 facets of fintech, and we're looking at robo advisories, we're looking at alternative data, we're looking at cryptocurrencies and all these themes. And the quant in me is kind of saying, well, these are all themes you got to introduce, but I'm also split on how to kind of position them as, here are the innovations versus how do you kind of, say that, well, buyer beware. You can't just kind of go with all the cool things, but you got to contextualize it in the big scheme of investments. So how do you kind of give advice to students?
Well, if I were teaching that class, I would have a huge part of it from the beginning on understanding risk in financial markets in different ways within an investment horizon, depending on the investment horizon, the impact of regimes, the risk, how the risk can be different between individual securities and portfolios of securities. And so there's a lot that you can do there just in terms of the basics of getting a better intuitive feel for risk. And the other thing I would say is that I don't think that, retail investors, many of them are incredibly sophisticated, and they do incredibly deep research. And so I think it's really hard to paint a broad brush on retail versus institutional investors and so on. There is speculation in markets, and Sri, that will be your challenge. Your challenge will be that some of your students will raise their hands and say, yeah, you're teaching me all of that, huh? I just tripled my money on Bitcoin.
Absolutely.
We'll have comments for this presentation probably about that.
Or GameStop.
So I'll let Larry teach the Bodhi class, and then I'll start mine.
So Sebastian, I saw an interesting online comment by somebody asking about Bitcoin. Should I own one cryptocurrency or should I diversify across many cryptocurrencies? And of course, you probably know cryptocurrencies have a correlation of 1 right now. Maybe not in the future, there will be only one surviving cryptocurrency. But so given the discussion of something like that, where you have no forecastability, there's no alpha and high correlation, how would you frame the discussion with somebody about that decision to diversify or not, or run away?
I think someone who's been invested in these cryptos has had really, really sharp ups and downs, even on a daily basis. So don't underestimate their understanding of the risk of being invested. It's also been the best performing asset class for the last 10 years because of the rarity of it. Look, I don't necessarily have strong views on this. I think I have more of a wait and see approach personally to it. I don't really have strong dogmatic views on it. I think there's like any speculative asset, when there's a limited supply and there's demand for it, I'm sure some of you on this call pay upwards of $100 for certain bottles of wine. In fact, I know some of you do that because they're rare. There's limited supply and there's more people willing to buy it. So that becomes a speculative asset. it has implications for the long run. There's just still a lot that we have to discover here with the blockchain and what it means for financial markets. The argument that it's a surrogate for traditional currencies, to me, is hard to understand, because you know, if you have 20% daily volatility, just given the volatility in those, it's really hard for me to equate those to currencies and store value and method of payment. But somehow that argument's being made too. So I don't know. It's a good question.
So just to follow up on this, I've seen the argument made by like the CEO of Galaxy Digital, or well, some very high profile investors saying that Bitcoin has a place, very small place, like 1% of people's portfolios. Does that ring as true or false, or to you, because it's a new asset class and it's uncorrelated with normal assets?
No, I think it really, I hate to say this, but it depends. I really don't have a strong view on this one. It depends if you're really interested in the asset class. Some people invest in it for philosophical reasons because it's decentralized, no one owns it. Some people invest for investment reasons. Some people invest for speculative reasons. It really depends how you approach it. As I said, I'm more in a wait and see mode. And clearly I've missed the boat over the last few months, personally.
Sebastian, I have one more question.
Okay. Okay.
How the hidden Markov model, HMM, the regime switching model helped you above and beyond utilizing simply say implied volatility, forward-looking volatility in timing the market?
Yeah, those models, there's a paper on that again, co-authored with Mark and Dave Turkington, and it's about regime switching models. And it shows that the hidden Markov models really help you understand which regime you're in, and also assign probabilities to the different regimes going forward. And they're helpful for risk timing, and that risk timing can translate into tactical asset allocation decisions. Mm-hmm. So there's a bunch of back tests in that paper that I think are quite interesting, just in terms of it goes back to my presentation today, right? All these green numbers for persistence and risk. And if you do it with regimes, they're
very different.
There is an investment thesis you can make around forecasting regimes and risk that ultimately it's easier to do that than to just forecast returns, right? So if risk is more, and I say that in the book, right? Risk is more forecastable than returns. And so there are ways to use risk as a tactical asset allocation signal, and hidden Markov models are useful for that.
Yeah.
Thank you for taking it away from Bitcoin. I'm clearly uncomfortable answering Bitcoin. It's just such a polarizing topic. And if you go on YouTube and you look at what Rubini has to say about it, you get one side of the equation, and then you look at other CEOs involved in Bitcoin companies that say that it's going to the moon, and it's just incredibly polarizing.
There was another question posted there. Say, can you comment on the principal component analysis-based measures such as absorption ratio? I was step away a few minutes ago. Sorry, whether or not that has been answered. Yeah. Do they have any place in asset allocation decision making? Once a high percentage variance explains by small number of factors, how much you strategy adapt? Yeah, that was the question.
Yeah, I talked about it earlier. I do think systemic risk, and Chell, who's on the call, and others will have indicators to tell you that. I do think it's not as high as it was, for example, prior to 2008, where you had all the structured products layered on top of each other's with derivatives and all that loaded up on banks' balance sheet. Everything was connected. It's scary when you think in hindsight about it. I don't think we're in that environment, but I do think that the increase in liquidity flooding the markets on the margin will increase systemic risk. But for example, if Bitcoin blows up or if some SPACs blow up, you could still get the recovery trade in value stocks, and banks do well in rising rates, right? So I think we have less of a one factor kind of risk pending right now.
Okay, thank you.
Any other questions? Last call.
I see more questions on Bitcoin coming. It's time to end the call.
Yeah, so any other Bitcoin questions, we will address them offline, depending on the volatility on that particular day. We'll take prior information and then answer it accordingly, I guess.
Yeah, Sebastian, I wish your book talked a little bit more about leverage impact.
Next one.
Okay.
It really is an important concept that I missed. Next book, one day.
Yeah. Yes. Thank you.
Thank you, Sebastian. Thank you for taking time off your vacation and spending these hours in the evening with us. This was an absolute pleasure. Hugh, any last thoughts?
Yeah, I just want to thank Sebastian for presenting. Thank you very much.
Thank you for inviting me.
Thank you. And Sebastian, if you could share the slides, we will make sure that the audience and also the people who are registered will get a copy of the slides and the video.
They're on their way. Thank you all.
It's nice seeing you.
Have a good night. Bye-bye.
Thanks, everybody.